Media world. I'm C. Radhika Singhal. So in the last session we discussed two non-DSF techniques, which is payback and ARR, and also we discussed one DSF technique, which is NPV technique. So today we are going to start with the others NPV technique. But before starting that, let's discuss certain assumptions that we are going to use while resolving any DCF problems. So project cash flows could be a capital outflow like purchase of an asset and the working capital outflows. So capital outflows is like investment in the fixed assets and working capital is the investment in current assets. And the cash inflows could be the revenue cash inflow and could be terminal cash inflow. So revenue cash inflow is the net cash revenue that you earn from the operations or because of that project after tax, and terminal cash inflows is the like if you sold any asset, whatever scrap value that is left is the terminal cash inflow. So in DCF problems, we have certain assumptions regarding the time period of the realization of these. So for a capital outflow, it is always assumed that the outflow is at the beginning of the year 1 or 0 period. So if nothing is mentioned in the problem, like an asset has been purchased, we assume that the asset has been purchased at 0 period. And as compared to the working capital outflows, it is assumed that whenever the company has commenced its operation, the working capital outflow commenced from that date. So if a company has purchased the asset at 0 period and after 1 year, that is a gestation period, it started business operations. So the working capital outflow will start after 1 year. Now if we talk regarding revenues, the first is the revenue inflow. So revenue inflow, though the earnings are throughout the year. Let's say that in year 1 the income is 1 lakh rupees. So this 1 lakh is not earned at a point of time, it is throughout the year. But for DCF problems, we assume that it is earned at the end of the year for terminal cash inflows. So terminal cash inflows could be from capital outlays or it could be from working capital outflows. So when we talk regarding capital, it could be a depreciable asset or it could be a non-depreciable capital asset. So for depreciable capital asset, we always assume that the realizable value is 0. So there is no scrap value for that asset since it is being depreciated fully. So if there is any realizable value of the scrap, we take that value. For non-depreciable capital asset, we assume that whatever amount that we have invested is actually recovered at the end of the period. So if the project is of 6 years and a non-depreciable asset has been acquired, so after 6 years, the value will be the same as the original investment value. So this is for the capital assets. For the working capital assets, we always assume that at the end of the year, it is 100% recovery of the working capital investment. So cash flow out of tax is when we exclude the non-cash expenses like depreciation. Depreciation does not involve any inflow, but that is saved tax at one point. So to compute cash flow after tax, we have to compute a cash flow before reducing depreciation and the tax amount after taking depreciation into consideration. Compute CFAT. Let's take one example. The sales are 10 lakh rupees, material cost 2 lakh, labor cost 1 lakh rupees. The cash expenses are 1 lakh, depreciation 2 lakh. So if I ask you to compute profit, you will simply reduce 2 plus 1 plus 1 plus 2 from 10 lakh rupees and you get the profit. But depreciation is a non-cash expense. So we'll first compute the cash flow before tax, excluding depreciation, which will give us that CFBT is 6 lakh rupees. Now, since the tax is imposed on an amount or a profit after depreciation, so we'll reduce depreciation 2 lakh rupees and then we will apply the tax amount. So tax amount will be 40% of it. So we get a profit after tax of 2 lakh 40. In this, if we add back the non-cash expense, we'll get the cash flow after tax. Or in other words, in order to compute cash flow after tax, we can actually reduce the tax amount, which is 1 lakh 60, from our cash flow before tax, which is 6 lakh rupees. So the cash flow after tax in this case will be 4,40,000. So this is also a way to compute CFAT, and this latter one is the preferable way for computing CFAT. The other technique that we used in non-DCF one is in DCF is Profitability Index. So Profitability Index is basically a relationship between the present value of cash inflow to the present value of cash outflow. So Profitability Index will be 1 when PVCI is equals to PVCO, right? This means that in such scenario, there is no profit. When it is more than 1, the project is earning some profit or is beneficial. When it is less than 1, the outflow is more than inflow and it is not beneficial. So the decision criteria in case of profitability index is if the profitability index is more than 1, it is acceptable. Otherwise, it is not acceptable. And the higher the PVCI, the more beneficial it is for the organization. So when we have all the 3 projects in a mutually exclusive project, we will take the highest profitability index because in such scenario, the NPV will be highest and that project will be chosen. If the projects are complementary, we will sum up the PVCI of all the projects and the present value of cash flow of output projects. And then we will compute the profitability index. If that profitability index is more than 1, then we will accept all the complementary projects. Otherwise, we will reject all the complementary proposals. In case of independent projects, we will accept all those projects which has a PI of more than 1. So let's take an example. If the initial outlay of a project is rupees 1 lakh and it generates cash flow of rupees 50,000, 40,000, 30,000 and 20,000 in the 4 years of its lifespan. So you are required to calculate the profitability index. So first of all, what is the PVCO? 1 lakh. What is the PVCI? We have to compute taking the required rate of return. Let it to be 10%. So in all the 4 years, the cash flow actually has a PVCI of 1,14,680. So PI will be PVCI by PVCO, which is 1,14,680 divided by PVCO, 1 lakh rupees. So profitability index is 1.1468. Since this PI is more than 1, this project is acceptable. Next discounted cash flow technique is discounted payback period. What is the criticism for payback period? That it does not consider time value of money. So in discounted payback period, the payback period is computed after taking the required rate of return into consideration. That is after discounting the cash inflows by the required rate of return. So for this, instead of directly dividing the outflows with the inflow, we will have to first compute the present value of cash inflow. And the way we compute payback period, in the same way we are going to compute the discounting payback period. So we will first compute the cumulative present value cash inflow and then we will compute the cumulative PVCI. So in the last example that we just did, if I go back to that example again, the initial outlay was 1 lakh and it generated the cash inflow of 50,000, 40,000, 30,000 and 20,000 in the 4 years lifespan. So if we compute discounted payback period in this example, we'll first have to compute the PVCI, which we just computed in the last example, and then we then compute the cumulative PVCI. So in the 3rd year, it actually earned 1,01,020. And what is the cash outflow? 1 lakh rupees. So we'll interpolate 2 years plus what is the difference between 1,78,590, 21,510 divided by the difference between 1,01,020 to 78,490. And the difference between 2nd and 3rd year is 1 year multiplied by 1, which will give us a payback period of 2.95 years. Very simple. It's similar that way we computed PBP, except that in this case we computed the discounted payback period by taking the discount rate into consideration. Today we are going to cover till discounted. In the next session, we will cover the other techniques. In case of any query, just leave a comment. Thank you. Have a nice day and keep smiling.